We're not in a recession, in your view, and we may be able to avoid a recession.
Yeah, as the chair said, we're not in recession right now. We do have these 2 quarters of negative GDP growth. To some extent, a recession is in the eye of the beholder. There is an official dating committee, which isn't really official, the NBR dating committee. And that's really Bob Hall, professor at Stanford, so he makes the call. But with all the job growth in the first half of the year, it's hard to say that there was a recession. With a flat unemployment rate at 3.6%, it's hard to say there's a recession. So the second quarter slowdown was, I think, more concerning. I think the first quarter slowdown was, negative GDP was probably a fluke, but the second quarter, I think, was more concerning. And so I'll watch that carefully. But now what I think is going to happen in the second half of the year is that we'll get positive GDP growth in the second half. I think we'll have a reasonably good third quarter here. And so I think jobs will also hold up over the second half of the year. Job growth is slowing, but is slowing to a trend pace. So that's how I'm assessing it right now, but I'm watching it closely.
Yeah. It's one of the things Steve said throughout. Maybe don't use that first quarter. If we get a third or a second, if you don't use the first, then maybe it would be. You remember Potter Stewart's ask him, how do you define obscenity or obscene? Yeah. He says, I know it when I see it. That the reverse works for this percent. It doesn't look like that's what we're looking at. I don't think to anyone at this point. I guess because of the jobs picture.
Yeah, it's because the jobs market is so strong. And there are these other indicators. Of course, we're raising rates rapidly and tightening up on monetary policy. You're seeing some interest rate effects on interest-sensitive sectors. That's natural, I think, that's something you'd expect to see. But that doesn't all by itself mean that you're in recession just because you see some negative signs in some parts of the economy.
75, not usually done. Usually it's a quarter, and you'd probably like to get back to a quarter at this point. But not only you, but Mester and others have said it seems like inflation might be a little more persistent and a little worse than we thought, and we may need to do another biggie, and then before you get back to maybe quarter points. Why should we not think that you guys missed transitory, basically? You said transitory, and now you're overshooting the other way. Commodities are rolling over. There's all kinds of things.
Are you saying you don't trust our forecasting model?
I'm saying that if you were, too laissez-faire initially, too complacent initially with transitory, and now you get religion, and how do you know you aren't going to overdo it?
Yeah, we're gonna follow the data very carefully here, and I think we will get it right. Inflation is high, and we've had to move aggressively just to get back in position. I think one thing for everybody to remember is we're starting from an extremely low, near zero interest rate, and now we've raised up a fair amount, but we've still got some ways to go here to get to restrictive monetary policy. I've argued that now with the hotter inflation numbers in the spring, we should get to 3.75 to 4% this year. And, exactly whether you want to do that at a particular meeting or some other meeting, I think is a great question. I've liked front loading. I think it enhances our inflation-fighting credentials, keeps inflation expectations under control. We did do the 275 basis points in a row. That's Greenspan did one once in 1994, so I think in our situation here with the high inflation, it was appropriate to go twice in a row.